Just two bearded men talking about money.
This is Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
All right. Jason, welcome to the Roadmap to Retirement.
Thank you.
Excited to have you here.
I'm excited to be here. Thank you for having me.
I would give you an introduction, but I'd rather you do it yourself. So why don't we start with who you are, what you do, and how long you've been doing it.
My name is Jason Grover. I am the founder and only employee of Grover Financial Services. I've been in the business since 2007. I was part of a large independent team at Smith Barney. Went through the 2007, 2008 Great Recession, ended up at Manning and Napier for a short period of time, and then started Grover Financial Services in 2015. And have been here managing my own business ever since.
10 years. It's a good milestone.
It is a good milestone.
Did you know that?
Yes.
You knew that, but had it occurred to you that it's been 10 years?
It'll be 10 years in November.
Okay.
Yeah, it's pretty exciting.
It's a good milestone. We'll have to have a party for that.
Yeah.
So you came into the business at an interesting time. You started in 2007.
Yep.
Which means that when you thought you maybe knew what you're doing, or they let you think you knew what you're doing, the market tanked famously. You went through 2008, 2009.
Well, Smith Barney, I was fresh out of the Navy. And my degree's in professional aeronautics. And so I was trained to fix airplanes and run airports and maintenance facilities. So I convinced my wife somehow to move back home, move in with my mother-in-law, and I'm going to go be a stockbroker. And this was in October of 2007, and I was licensed in December of 2007. So everything really just started getting crazy at that time. So I had nobody to really help at that time. I didn't have any clients. I was part of a team. So my job was just to communicate with these clients and get on the phones. And it was a great lesson.
Okay. I think it's an interesting perspective that you have that I don't. So you came in the business during that.
Yeah.
I came in during a good market. I started out of college in 2014.
Okay.
The market did nothing but went up until 2020. We had some stuff go on.
Yep.
But I think for someone like yourself that started their career during such a volatile market, but also it lasted longer. So we're spoiled now with the market downturns we've had in recent history.
Yep.
That COVID happens in 2020 and like the market dips real quick, but by the end of the year, we're positive again. So how do you feel like that changes your approach to investments, having been through what you've been through because of when you started?
Great question. I think it taught me from the get-go, it was all about our behavior. And it isn't necessarily what the markets are doing, but how we react to the markets and the headlines, more importantly. I had some really great mentors that had some core philosophies. And at that time, I was just repeating what they believed because this is what they were telling me to do. But then as the market recovered in 2009, 2010, and people that listened to the advisors and, for a lack of a better term, behaved properly, fared very well. Were able to continue on with their goals, were able to meet their income needs, were able to take the grandchildren to Disney World if that's what they wanted to. For those that bailed on their plans and on their advisors' advice, they struggled. They struggled really hard. They had to either work longer, spend less, make some real big sacrifices. So I was very lucky early on that I had one, great mentors, and two, that I had those lessons very early, because it wasn't about the X's and O's or the dollars and cents. It was truly about behavioral management, which is something that I pride myself on today. I'm a behavioral manager more than a financial advisor.
Okay. It is part advisor, part therapist at times.
Yes.
And I think you can only learn from your experiences. There's no substitution for experience. Comparing my career to your career, I still haven't been through that thing you've been through. And for me, I've had the hard conversations, which is what you're talking about, is the value of being able to have the hard conversation with the client. And I think back to 2020 and talking clients off the ledge, trying to get them to stay invested, which I think is the most important thing we can do in that time.
Yep.
But I had the advantage of it being such a short window that I only had to have that conversation for a few months, and the market came back, and then it got easy again. Or more recently, we had this tariff stuff going on, and we had a lot of questions about the volatility during that. And my message was exactly what yours would be, that let's stay the course. Volatility happens. You can't sell at a low. But I think that conversation gets harder and harder as it's not been 1 month, 2 months. Now it's been 18 months or 2 years.
Yep.
And we're still not seeing the recovery. And I can't say because I've never been through it. I'd like to think that I have the resource and the knowledge to stay the course, but it does get harder. And to talk to an advisor like yourself that's been through it is helpful to me as a younger advisor.
What I think helps more than anything is setting the stage for the experience while we're in good times. So I say very often, we're preparing for a 50% decline. And it scares the bejesus out of them a lot of times. Like, what do you mean? If are you expecting a 50% decline? I'm going, yes, I am, all the time. That's what we're doing here, is we're setting up your investments to be able to provide you your income. We need to protect your income from those 50% declines, but we also, more importantly, need to grow your income, because inflation has a lot more of a detriment to your financial plan than the short-term declines.
Sure.
And that's what I'm always preparing them for, is that 50% decline, which is what we had in 2008. So for me, it's about date-specific, dollar-specific written goals. 100% of the time. What are we trying to achieve? When do we need the money? What's the purpose of the money? And how do we allocate, or how do we take risk? So anybody that needs money today, that money should not be in the markets, because if you need to pay for something within the next year or two, it shouldn't have a risk of losing 50% of it in any given moment. So we always want to have some kind of protection aspect to the portfolio or to the plan. So I have a philosophy of 2 to 5 years of income is always protected. If you need money within the next 2 years, it has no business in the market. Any money that you're protecting over 5 years is just emotional. The reason why 5 years is because we went through this Great Recession in 2008, where it was a little more than 5 years that the market fully recovered. So if we have a 2 to 5 year income protection plan, we're never forced to sell our assets at a loss while we're going through it. So Mr. and Mrs. Smith comes into the office. It's now year 3, and they're like, get me out. I can't take it anymore. Mr. and Mrs. Smith, we still have 2 more years of income. We don't have to bail on the plan yet. Let's act on our plan. Let's not react to the markets.
Sure. I think that's a great philosophy. I like to frame it as the bucket approach, and I'm sure you maybe use the term buckets also.
Yep.
But it's the same thing. We've got our short, mid, and long-term bucket, and
Yep.
saying that I'm okay taking a lot of risk with that long-term bucket, especially because I know that I've got, in your example, that 3 to 5 years of income sitting there.
Yep.
And I think for a lot of clients, they're already doing that. If you look at their 401k statement, they send you that pie chart with the color-coded things.
Yep.
You've already got a little bit in cash, a little bit in bonds, a little bit of stock. So you're already doing that in a way. But if you just put it in the terms for a client, I think it's helpful to give them peace of mind to look at the long-term bucket when the statement comes in the mail, or they look online and they see COVID happened, I'm down 20%.
Yep.
But they can still sleep at night because they pick up the next piece of paper, or they go to the next screen, whatever it is, and they see my short-term bucket is still exactly where it was before. I know I can still go on that vacation. I can still spend time with my grandkids. Whatever the thing is that motivates them, they still have that. I like buckets, but
Buckets, same theory.
good word.
Yep.
Yeah. Semantics.
Yeah, it's just, I look at it as the years of income protection, because then we have a young person that has a conservative portfolio, and I think that's just as dangerous as an aggressive portfolio for an older couple, because what are they protecting? They don't need this money for 15, 20 years. They shouldn't have a stable bucket. That money is not necessary for that. And now they're losing purchasing power, and the purchasing power is what we're trying to maintain more than anything else.
Yeah, if you so the opportunity cost between a conservative portfolio and an aggressive portfolio, and then you multiply that out for 30, 40 years, whatever it is. And I think we have the same conversation a lot with older people that maybe they're living on Social Security and their pension. They've got $1 million sitting in IRA assets.
Yep.
And even though that's their money, and I hope they spend some of it or most of it, there's a reality there that they're probably not going to spend all of it. So breaking off a section of that portfolio and saying, even though you're in your 70s now and you don't feel like you have a long time horizon, the reality is the person that's going to spend this money, your kids, grandkids, whoever it is, does have a long time horizon. So let's take more risk than the average 75-year-old would, because we're recognizing that we have a lot of time and we want to grow that bucket.
Yep.
And yes, plans change and maybe you need that money. We'll talk about it if that happens, but you're leaving a lot of money on the table by being overly conservative.
This is what I don't like about the compliance questionnaires, is because now the questionnaires are designing portfolios based on answers to questions that are about their emotions. And so if you're designing a portfolio based on somebody's emotions and not their goals, it could be allocated totally incorrect.
Sure.
Because in your example there, that money is going to be used by people that are currently 30 years old. So why the heck are
Sure.
we being so conservative with
Not to
that?
mention if it's in a non-retirement account, you have the step up in basis, you have tax benefits for appreciation. We could talk about that to your point about what you're just saying. It reminds me of target date funds. We have the same problem with the retiree that says, I'm going to retire in 2030. So I picked the 2030 target date fund.
Yeah.
But it's okay, let's take a step back there. And
Yep.
are you going to use all of this money in 2030?
Yeah.
And if the answer is no, we probably need to reevaluate the way that we're using that.
Yeah, whenever we utilize or whenever I recommend a target date fund, I'm digging a little deeper and I'm looking at the asset allocation, the breakup of stocks versus bonds of that fund, because their financial plan may say, okay, you should be in an 80-20, 80% stock, 20% bond. The 2025 or 2030 fund is going to be more
not
like
bad.
a 50-50. So yeah, you may be retiring in 2030, but you really should be in the 2050 fund. And I'm not making a recommendation. I just want to look at that asset allocation.
Sure.
The thing that I really don't like about target date funds is that you can't choose where you're taking the money from. If you need income from a target date fund, they sell everything. So if your portfolios, if you need income in a down market, you're selling your stocks at a loss to generate income. And so that is something that I wholeheartedly disagree with. That's what your income bucket's for. So you can avoid trading at a loss just for your income purposes. So target date funds are great if you're not going to do the research, if you're not going to listen to a financial advisor or get professional advice. I definitely think there's a purpose for them, but I am not a huge fan of them.
Yeah, I would
unless
agree
you're
with that.
looking at the asset allocation.
I think that's true. I guess I'm more okay with them for a younger, but like if you're 30 years old and you want to pick the 2065 target date fund, it's probably okay. 99% of the time, it's going to be an aggressive fund and
Yep.
you're not going to have to worry about it for a while. It's as you get closer to retirement and we want to start to time segment that money, and the questionnaires are very misleading, like you said. I think there's more value in working with a financial advisor at that point. And hopefully by the time you're taking distributions, you've been able to get the money out of that 401k plan into an IRA that allows you to have a little bit more control over
A lot
it.
more control. Yeah. I'm glad that you clarified that, because I agree with everything that you just
So
said.
I do get that question a lot from younger investors that are clients, and they bring up their stream, they share their stream with me. They say, this is my 401k. What do you think of these funds? And a couple of problems. One, your 401k inherently is pretty limited on your fund selection. They have
Yep.
a menu of funds that's going to be the target date funds, maybe a couple allocation funds, and maybe a random small cap fund that's in there for whatever
Right.
reason. So a lot of times the target date fund is your best option if you're 30 something years old and you're not going to touch the money for a long time. As you get closer to retirement, hopefully you have the option to either roll it out at 59 and a half, or as you retire, you do. So not bad, but it depends.
Yeah, I didn't mean to come across as putting target date funds down. They have a purpose. I think that there's also, the target date is going through retirement or to retirement. And so the asset allocation will also be different in that case as well. I just feel that they're way more conservative. I know they're way more conservative than what most financial plans will dictate.
Yes, correct. I do get a chuckle, not to pick on anybody, but when I pull up a client shows their 401k statement and I look on it, and they've chosen to be diversified. So they have the 2025
Yes.
target date fund and the 2030 target date fund,
Yeah.
and sometimes the 2035 target date fund. And then you have to have a conversation about how those are all actually the same and
Yeah.
they're not diversifying.
They're exactly the same.
They are exactly. So we talked about the bucket approach. One other common question I get, and we're talking about younger investors now, is people have cash in the bank and they have this long-term, midterm goal, but it's
Yep.
usually not that far away of, I want to buy a house and I've got $50,000 in the bank. Can you
Yep.
help me invest it so that I have more money to buy a house in 3 years?
Yeah.
And I know what you're going to say, but I'd like to hear you say it anyway.
Yeah. That money has no business being in the markets.
Correct.
Yeah.
And It's, Jason, if you find the house of your dreams and you gave me this $50,000 6 months ago to invest for you, and now you have $45,000, how's that going to feel? And to your point, what if you lose 50%, which
At any moment.
could happen?
Yeah.
But
That's always what surprises you, what you don't see or what you don't expect.
Yeah.
So if you're always expecting a decline in the equity portfolio, now, if you know that you're not going to be buying a house for another 5-6 years, then a diversified portfolio would be appropriate for that money. If you're searching, if any money that you need within 2 years has no business being in anything but cash equivalent, that's simple.
cash is great. High yield savings accounts are great.
That would be great.
That
Anything
option-
liquid, nothing that would have a penalty.
That's a good segue. So we get a lot of questions about CDs, which
Okay.
nailed it. My thoughts on CD is always, if you have money that needs to be liquid,
Yep.
CD is not the answer. If you have money that
No.
you know you're not going to touch for a long time, CD is not the answer. So unless you have a very specific, I know that I need money 12 months from today,
Yep.
I could start to get to where a CD is reasonable. But for me, if I have an emergency fund, if I have liquidity, if I want money in the bank, I need it to be truly liquid.
Not a CD.
Not a CD. Do you have an example of when a CD does make sense in your mind?
If I'm laddering income, so I know that if I know I need income, a specific amount of money over a period of time, I'll ladder CDs. If I have a conservative portfolio or just a bucket of money that we don't want to put at risk, but we really don't have a purpose for it, I may do like a 2 to 5 year CD ladder where, okay, we have $50,000. I'm putting $10,000 in a laddered CD. A ladder comes, the $10,000 come due. Do we need the money? No. I'll buy another 5-year CD and just cycle that money. So I have cash available to make a decision every year. Those are really the only.
It's pretty rare.
Yeah. For people that are taking income, I'll do that.
Yeah. Okay.
I'll either do a corporate bond ladder, but if yields aren't attractive and I can get a decent yield on CDs, I'll do that.
Okay.
But I'm not a big fan of them in general
Yeah.
because unless you have a purpose, I'm going to take all the kids to Disney World in 2027. I'll buy a 2-year CD because I'll put the money away today for tomorrow.
I think even then I would argue that the liquidity is worth the spread in the rate of return. If the CD is paying 5% and I get a high yield account in a bank paying 4.5%, for the half percentage, I want access in an emergency or if something changes.
But the high yield's variable. And so interest rates change. That's out of your control. If you're buying a CD, you know what the rate of return is.
Yeah, that's a fair point.
And what everything is. So there's a specific goal, specific dollar amount. We can calculate that in. We know what the rate is. Yeah, we have money markets that we have access to. They're paying 4.25% right now. And why would I'll lock in 4.25% for 2 years,
Yeah.
3 years.
Give me the money market in that situation.
Exactly.
All right. We went down a tangent of CDs, which I didn't see coming.
Yeah, but they're in the wheelhouse. They're not my go-to.
Yeah. We were talking before we started filming here about Nick Murray, who's been, I guess, influential in your career.
Yeah, he's a mentor of mine. Absolutely.
Tell people about Nick Murray.
Nick Murray is the financial advisor's advisor. He has written many books geared towards the financial advisor on philosophies, mainly about behavioral management. He has been tremendous in the creation of my philosophies and my practices and how I go about my daily business. He's only written one book for clients, and I think majority of my clients have every version of that book. And Simple Wealth, Inevitable Wealth. It isn't. You can find it on Amazon. It isn't coming from him, but it's out there, and it's a great little book to share my philosophy of how I manage money, how I help people manage their wealth, and and their families. So he's been instrumental. He's one of a few mentors of mine. That's for sure.
That's cool. I know the managing the emotions is such a big part of it.
That's everything.
That's what we were talking about before with the market volatility. If we're talking about COVID or 2008 or whatever it is, it's a big part of being a financial advisor is keeping people invested when it's scary.
Yeah, the money is easy. The finding the investments is fun. I can nerd out with anyone about that, but it's how we act on any given amount of information that's so important.
Sure.
It's my job is to prevent you from making big mistakes. And the biggest mistake is the one that you're about to make.
So one you don't know about until it is the worst feeling as an advisor when you sit down with, maybe it's a new client or somebody you're meeting for the first time, and they start to talk about something they did a month ago, and you're sitting there gritting your teeth because you don't want to make them feel bad about it because they didn't know, but also they just made a
Big
pretty
mistake.
expensive mistake and they can't undo it. So a lot of times the value of an advisor is preventing you from doing the thing you're about to do. And we can't go back. So you can't wait till you make the mistake and then go.
That's why it's never too early and never too late to start building a plan, working with a professional, and getting date specific, dollar specific written plans. That's really the key point. So we can go back to it and say, okay, we were of sound mind and the markets were in what we considered normal. These are the goals that we decided that we were going to achieve. So this is what we're shoot for. So what's changed? If the goals haven't changed, why are we changing them?
Yeah. Everyone's a big risk taker when the market's going up. And then all of a sudden you're having a conversation 6 months later and suddenly they feel much more conservative. And that's part of the flaw of the whole risk tolerance questionnaire and that kind of stuff. It's a compliance tool. It's not real.
What's the dollar? When do you need the money? How much do you need it? What's the allocation necessary to get you there? What is the amount of money that you could put away every single month? And let's make it happen. It's pretty straightforward. And then everything else is noise.
Cool. Love it. Let's take action. We're wrapping up here, but before we do that, Jason, how can the people find you? I know you have a YouTube channel you've been working on.
Yeah, we just launched it at Grover Financial Services. That's on YouTube. My website's groverfinancialservices.com. I have a newsletter called Financial Vitamin C, and as well as some video series that we've just launched. But I'm always a phone call, an email, a click away. Thank you for the opportunity.
Absolutely. Thank you for being here.
Cheers.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax or legal matters should be discussed with your tax or legal professional. Jason Grover AIF is not affiliated with Cultivate Financial Planning.